In October 2001, a company called Enron reported $618 million in losses. 3 weeks later, it admitted those losses were actually closer to $1.2 billion. 6 weeks after that, Enron, the seventh largest corporation in America, filed for bankruptcy. 11,000 people lost their jobs overnight. Retirement accounts evaporated. And then, investigators found something worse. Enron's accounting firm, Arthur Andersen, had been shredding documents by the truckload. This wasn't just fraud. It was a structural crack in the foundation of American capitalism. Here's what made Enron different from every other corporate scandal before it. The crime wasn't hidden in a back room. It was published, audited, approved by one of the most respected accounting firms in the world. Arthur Andersen employed 85,000 people across 84 countries. They weren't a rogue operation. They were the establishment. And that's the part that terrified regulators. Because if Arthur Andersen could sign off on books that were completely fictional, then every earnings report, every quarterly statement, every number investors used to value companies, all of it was suddenly suspect. The stock market didn't just lose confidence in Enron, it started losing confidence in accounting itself. Within months, the crisis spread. WorldCom, Tyco, Adelphia, Global Crossing. One after another, major corporations revealed that their financials were built on the same kind of creative math. By mid-2002, trillions of dollars in market value had disappeared. To understand how this happened, you need to understand what accounting firms actually do. When a company releases its financial statements, it's not enough for them to just say, "Trust us." Investors need an independent third party to verify the numbers. That's the auditor. The auditor's job is to examine the books and certify that everything is accurate and follows the rules. In theory, this creates a check on corporate dishonesty. In practice, it created a conflict of interest so obvious it's almost embarrassing. Here's the problem. Companies hire their own auditors, and they don't just pay them to audit, they pay them for consulting, tax advice, IT services, all kinds of lucrative side work. By 2000, Arthur Andersen was making more money from consulting Enron than from auditing them. In 1 year, Enron paid Andersen $52 million. Only $25 million of that was for the actual audit. So imagine you're the auditor. Your firm is pulling in tens of millions from this one client, and that client's CFO asks you to approve an accounting method that's, let's say, creative. Technically legal, but aggressive. If you say no, they might fire you, and your firm loses the revenue. Now multiply that tension across every major corporation in America, and you start to see why the system was built to fail. Enron's specific trick was something called mark-to-market accounting. Here's how it worked. Let's say Enron signs a 20-year energy contract. Normally, you'd record revenue as you actually earn it, year by year, as the money comes in. But mark-to-market accounting let Enron record the entire estimated profit from that contract immediately, day one, before they'd delivered a single kilowatt of power. The key word there is estimated, because Enron got to decide what the future profit would be. They built financial models, made assumptions about energy prices, and booked whatever number made their quarterly targets look good. If the contract ended up being less profitable than expected, they'd quietly adjust it later. If it lost money, well, they had another trick for that. Enron created thousands of off-balance sheet entities, special-purpose vehicles with names like CHUCO and JEDI. These weren't subsidiaries. They were separate legal structures, technically independent, which meant Enron didn't have to report their debts on the main balance sheet. So when a deal went bad, Enron would shove the losses into one of these entities. The debt disappeared from view. Investors saw a clean, profitable company. The reality was a shell game, and Arthur Andersen signed off on all of it, because the rules were vague enough that you could argue it was compliant, and because saying no meant losing the client. When Enron collapsed, the immediate question was, how did no one catch this? The answer is that some people did. Short sellers had been circulating reports for months, pointing out that Enron's cash flow didn't match its reported earnings. Journalists asked questions that executives dodged. But the market didn't care. Enron's stock kept climbing because the official numbers, the audited numbers, said everything was fine. That's the insidious part. The fraud wasn't just internal, it was certified. It had the stamp of legitimacy that the entire financial system runs on. And then in March 2002, Arthur Andersen was indicted for obstruction of justice. Not for the accounting itself, for shredding the evidence afterward. The firm was convicted, and even though the conviction was later overturned on appeal, it didn't matter. Arthur Andersen collapsed anyway. 85,000 people lost their jobs. Thousands of Arthur Andersen's clients had to scramble to find new auditors. And suddenly there were only 4 major accounting firms left in the entire world capable of auditing large public companies. 4 firms, auditing trillions of dollars in corporate assets, with the same conflict of interest still baked into the business model. The political response came fast. Congress passed the Sarbanes-Oxley Act in 2002, one of the most significant corporate reforms in American history. Sarbanes-Oxley did a few big things. It created a new regulatory body to oversee auditors. It required CEOs and CFOs to personally certify their financial statements under penalty of criminal prosecution. It banned accounting firms from providing certain consulting services to their audit clients. And it imposed strict rules about how companies had to document their internal controls. On paper, it closed the loopholes. In practice, it made compliance incredibly expensive. Smaller companies complained that the cost of Sarbanes-Oxley compliance was forcing them to stay private or delist from exchanges. Larger companies hired armies of accountants just to manage the new paperwork. But the law worked, for a while. The decade after Enron saw relatively few major accounting frauds. And then came 2008. The financial crisis wasn't an accounting scandal in the Enron sense. Banks weren't faking their revenue, but they were using accounting rules to hide risk in almost the exact same way. The mechanism was different. This time it was mortgage-backed securities and off-balance sheet vehicles called SIVs. But the structural flaw was identical. Banks used creative accounting to make toxic assets look safe. Rating agencies signed off. Auditors approved. And when the house of cards collapsed, the entire economy nearly went with it. Lehman Brothers alone had over $600 billion in assets that weren't properly reflected on its balance sheet. When it failed, it triggered a cascade that required trillions in government intervention to stop. The accounting rules got tightened again. But here's the uncomfortable truth. The system still relies on trust. Trust that companies are being honest. Trust that auditors are being independent. Trust that regulators are staying ahead of the next loophole. And history suggests that's a fragile foundation. Today, the big 4 accounting firms, Deloitte, PwC, EY, and KPMG, audit nearly every major corporation on Earth. They're larger and more powerful than Arthur Andersen ever was. And the core conflict of interest hasn't changed. Companies still hire their own auditors. Auditors still have financial incentives to keep clients happy. There have been calls to rotate auditors, or to have a public system assign them randomly, or to separate auditing from consulting entirely. None of those reforms have happened, because the firms are too embedded, and because changing the system would be expensive and disruptive. So we're left with a compromise. Stricter rules, heavier penalties, more oversight. It's better than it was in 2001, but it's not foolproof. Every few years, another scandal surfaces. Wirecard in Germany, Luckin Coffee in China. Smaller than Enron, but the pattern is familiar. Aggressive accounting, delayed scrutiny, and a moment where everyone asks, how did the auditors miss this? The answer is usually the same. They didn't miss it. They made a judgment call, and the incentives pointed the wrong way. Which raises a question that still doesn't have a clean answer. If the gatekeepers are compromised, who's actually guarding the gate? I hope you enjoy this video. Don't just watch, subscribe, like, comment, and share to help others see this too.